Jim Rickards, prepare for a maximum Chinese yuan devaluation. The Chinese yuan has been falling against the dollar lately, but Jim says there could be a shocking devaluation coming. Here's why. By Jim Rickards via Daily Reckoning. The news is being dominated by breathless headlines about the new trade war between the US and China. But this trade war has been brewing for years and came as no surprise to readers of my newsletter, Project Prophesy. In fact, the new trade war is simply a continuation of the currency wars that began in 2010. I've warned for over a year that President Trump's threats of tariffs should be taken seriously, while most of Wall Street discounted Trump's talk as mere bluster. Now the trade wars are here as we expected, and they will get much worse before they are resolved. Currency wars arise in a condition of too much debt and too little growth. Economic powers try to steal growth from their trading partners by devaluing their currencies to promote exports and import inflation. But China can't keep going with tariffs. They only import about $150 billion of US exports. At the rate they're going, they'll run out of goods to impose tariffs on. Trump can keep going because the US imports so much more from China than they buy from us. But the Chinese are obsessed with not losing face. Chinese President Xi has just been named in effect dictator for life. He doesn't want to start out his new dictatorial regime by backing down from a stare-fest with Donald Trump. So he needs another option. For China to keep fighting, they need an asymmetric response. They need to fight the trade war with something other than tariffs. China holds over $1.2 trillion of US Treasury securities. Some analysts say China can dump those treasuries on world markets and drive up US interest rates. This will also drive up mortgage rates, damage the US housing market, and possibly drive the US economy into a recession. Analysts call this China's nuclear option when it comes to fighting a financial war with Trump. There's only one problem. The nuclear option is a dud. If China did sell some of their treasuries, they would hurt themselves because any increase in interest rates would reduce the market value of what they have left. Also, there are plenty of buyers around if China became a seller. Those treasuries would be bought up by US banks, or even the Fed itself. If China pursued an extreme version of this treasury dumping, the US president could stop it with a single phone call to the Treasury. That's because the US controls the digital ledger that records ownership of all Treasury securities. We could simply freeze the Chinese bond accounts in place and that would be the end of that. So, don't worry when you hear about China dumping US treasuries. China is stuck with them. It has no nuclear option in the treasury market. But if you can't win a trade war, you can try winning a currency war instead. I just argued that China's nuclear option in the trade wars is a dud. But, that does not mean China is out of bullets in a financial war. China cannot impose as many tariffs as Trump because they don't buy as much from us as we buy from them. China cannot dump treasuries because there are plenty of buyers and the president could stop the dumping by freezing China's accounts if things got out of hand in the treasury market. But China could use a real nuclear option to counteract the trade war by fighting a currency war. If Trump imposes 25% tariffs on Chinese goods, China could simply devalue their currency by 25%. That would make Chinese goods cheaper for US buyers by the same amount as the tariff. The net effect on price would be unchanged and Americans could keep buying Chinese goods at the same price in dollars. The impact of such a massive devaluation would not be limited to the trade war. A cheaper yuan exports deflation from China to the US and makes it harder for the Fed to meet its inflation target. Also, the last two times China tried to devalue its currency, August 2015 and December 2015, US stock markets crashed by over 11% in a matter of a few weeks. So, if the trade war escalates as I expect, don't worry about China dumping treasuries or imposing tariffs. Watch the currency. That's where China will strike back. When they do, US stock markets will be the first victims. Maybe you think that's unlikely because it would be such an extreme reaction by China. But you have to put yourself in the shoes of China's leadership. These aren't academic issues to China's leaders. They go to the heart of the government's very legitimacy. China's economy is not just about providing jobs, goods, and services. It is about regime survival for a Chinese Communist Party that faces an existential crisis if it fails to deliver. The overriding imperative of the Chinese leadership is to avoid societal unrest. If China encounters a financial crisis, Xi could quickly lose what the Chinese call the mandate of heaven. That's a term that describes the intangible goodwill and popular support needed by emperors to rule China for the past 3,000 years. If the mandate of heaven is lost, a ruler can fall quickly. Up to half of China's investment is a complete waste. It does produce jobs and utilize inputs like cement, steel, copper, and glass. But the finished product, whether a city, train station, or sports arena, is often a white elephant that will remain unused. Chinese growth has been reported in recent years as 6.5–10% but is actually closer to 5% or lower once an adjustment is made for the waste. The Chinese landscape is littered with ghost cities that have resulted from China's wasted investment and flawed development model. What's worse is that these white elephants are being financed with debt that can never be repaid. And no allowance has been made for the maintenance that will be needed to keep these white elephants in usable form if demand does rise in the future, which is doubtful. Essentially, China is on the horns of a dilemma with no good way out. On the one hand, China has driven growth for the past 8 years with excessive credit, wasted infrastructure investment and Ponzi schemes. The Chinese leadership knows this, but they had to keep the growth machine in high gear to create jobs for millions of migrants coming from the countryside to the city and to maintain jobs for the millions more already in the cities. The two ways to get rid of debt are deflation, which results in write-offs, bankruptcies and unemployment, or inflation, which results in theft of purchasing power, similar to a tax increase. Both alternatives are unacceptable to the communists because they lack the political legitimacy to endure either unemployment or inflation. Either policy would cause social unrest and unleash revolutionary potential. China's internal contradictions are catching up with it. China has to confront an insolvent banking system, a real estate bubble, and a $1 trillion wealth management product Ponzi scheme that is starting to fall apart. A much weaker yuan would give China some policy space in terms of using its reserves to paper over some of these problems. A maxi devaluation of their currency is probably the best way to avoid the social unrest that terrifies China. When that happens, possibly later this year in response to Trump's trade war, the effects will not be confined to China. A shock yuan maxi devaluation will be the shot heard round the world as it was in August and December 2015, both times, US stocks fell over 10% in a matter of weeks. China doesn't have a trade war nuclear option. But it does have one very powerful weapon. And it looks like it could be getting ready to use it. Jim Rickards, China to devalue the yuan until its stock market crashes. Says China will continue to devalue the yuan until the stock market crashes. Here's why the Chinese are doing it. Editor's note: with the recent analysis of the gold price to dollar/yuan correlation, if the plan is to continue to devalue the yuan as the weapon of choice in the trade war, this could have some serious implications for the price of gold. See all of that analysis on our China Controls Gold Price pages. By Jim Rickards of Daily Reckoning. When I say the fix is in for FXI, that's not meant to be mysterious. FXI is the ticker symbol for a U.S. exchange-traded fund, ETF, composed of the largest Chinese stocks. The phrase "the fix is in" simply refers to government-backed manipulation. When you combine the two into a government plan to tank their own stock market, at least to a point, you're as close to a sure thing as stock market indexes allow these days. That's exactly what's going on in China right now. A currency devaluation will likely lead to a stock market collapse, but it's a trade-off China is willing to accept because a cheaper currency will stimulate exports and support jobs. China's motives in market manipulation are about social stability more than profit and loss. Of course, the Chinese have nothing against making money, they're good at it. But China is controlled by a Communist Party dictatorship that is most concerned about its self-perpetuation. That self-perpetuation can involve prison camps, thought control, and torture if needed, but on a day-to-day basis it's more likely to involve avoidance of inflation, unemployment, and market panics, versus slow, steady declines. Investors with vague or no recollection of the 1989 Tiananmen Square protest and massacre Indiana Beijing have been taught to recall the event as a pro-democracy student rally complete with a 33-foot-tall papier-mâché statue called the Goddess of Democracy that was destroyed as the military cleared the square. That's a highly selective and misleading portrait of the overall protest. It's true that student demonstrators placed demands for more freedom of the press and freedom of speech in their petitions. Yet the origins of the protest were economic. Rapid economic growth in the 1980s had resulted in large gains for some but had marginalized and disgruntled many others. Inflation was a real tax on those with limited resources and an easily avoided inconvenience for the rich. It was these economic grievances, inequality and inflation, that gave rise to the protests. The pro-democracy aspects were tacked on in the later stages as the crowds grew. Initially, the Communist Party leadership was divided between moderates, like Zhao Ziyang, who favored some dialogue with the protesters, and hardliners, like de facto leader Deng Xiaoping, who favored a forced breakup of the protest and the arrest of its leaders. In the end, the hardliners got the upper hand and the result was a violent military attack on the demonstration. Death estimates vary widely and cannot be verified but range from 1,000 to 10,000 dead protesters. Communist Party leadership itself was thrown into chaos in the aftermath of Tiananmen, with Zhao Ziyang being purged and Jiang Zemin being installed as the new hardline party leader. The ghosts of Tiananmen still haunt the Communist Party leadership almost 30 years later. Economic warfare between China and its trading counterparties is not mainly about economics. It's mainly about social stability in China, which means avoidance of new mass protests and suppression of widely voiced political dissent. This econo-political history brings us to the ongoing trade war between China and the US. A superficial account of the trade war says it was started by President Trump last winter with his imposition of tariffs on Chinese, and other, goods imported into the US, including steel, aluminum, and certain appliances. China retaliated with tariffs on US imports. Trump doubled down with U.S. tariffs on a much longer list of Chinese goods and imposed penalties for Chinese theft of U.S. intellectual property. China retaliated again, and Trump doubled down again. These tit-for-tat tariffs were rising in $10 billion bumps. Suddenly the happy talk about posturing and empty threats was swept aside. A full-scale, red-hot trade war was underway. This recent outline is accurate as far as it goes. Yet it leaves out a much longer and more complicated backstory. On December 11, 2001, China was formally admitted to the World Trade Organization, WTO, the legal successor to the General Agreement on Tariffs and Trade, GATT, one of the original Bretton Woods institutions from 1944. China's admission to the WTO was the result of years of negotiations and substantive concessions on the part of China. Despite those perceived concessions, China secretly pursued the same policy it has used at the UN Security Council, the IMF, and other multilateral organizations it has joined in recent years. Here's an easy metaphor that captures Chinese behavior. Imagine you're on the admissions committee at an exclusive club. Your club has a strict dress code that involves jackets, ties, and leather shoes even on casual occasions. A new potential member has applied. They go through the interview process, bring recommendations, are informed about the dress code and agree to strict adherence. The new member is admitted. The next day the new member shows up at the bar in cutoffs, flip-flops and a t-shirt. Your club has a problem. China's the same way. They go through rigorous vetting. The organization rules and procedures are carefully explained. China agrees to play by the rules and is formally admitted. The next day, China proceeds to break every rule in the book and, in effect, dares the leadership to sanction them. The sanctions never arrive. The group has a problem. From this perspective, the trade war did not begin in 2018, it began in 2001. It was not started by President Trump, it was started by China through rule breaking, theft of intellectual property, export dumping and slow-rolling open markets. When China joined the WTO, its trade surplus with the US was about $100 billion per year. Today China's trade surplus with the US is about $400 billion per year and rising. This surplus is in addition to the theft of over $600 billion of intellectual property. The 17-year wealth transfer from the US to China now exceeds $3 trillion. Viewed this way, Trump's 2018 tariffs on China were not the start of a trade war. They were a desperate effort to stop one before the US is looted further by the Chinese. In the short run, China has been able to see Trump's ante every time Trump increases tariffs. Yet China is crucially weak on this front. The US imports about $500 billion per year in goods from China and exports about $100 billion to China. The difference is the $400 billion per year trade deficit the US runs with China. China is getting close to tariffs on 100% of US imports. The US can still impose tariffs on another $400 billion of Chinese imports. This is what Trump referred to when he said the US cannot lose the trade war with China because we already lost. Trump's hope is that China will see it's playing a losing hand, meet Trump for negotiations and settle on lower tariffs all around. This could expand bilateral trade and be a boost to the global economy. So far, China has not sought reconciliation. Instead it has injected a currency war tactic into the trade wars to give it more leverage than would otherwise exist. Here's a chart that shows the radical devaluation of the Chinese yuan, CNY, against the dollar, USD, in the past 4 months. Chart 1. In the past 4 months, the Chinese yuan, CNY, has collapsed 8.5% against the US dollar, USD. From 6.28 to 6.88 per dollar. This is a greater collapse than the August 2015 3% shock devaluation that triggered an 11% US stock market collapse. This new devaluation will continue as part of China's play in the trade wars. This time a Chinese stock collapse is a more likely result. This currency devaluation is China's reply to Trump. If the yuan dropped 20% against the dollar, Chinese export costs would drop by about the same amount because yuan unit labor costs are a huge part of Chinese manufacturing costs. If Chinese export costs are $100 per unit, a 20% devaluation will lower those costs to $80 per unit. A 25% US tariff on the new $80 baseline will raise the export cost to $100 exactly where it started. China has discovered that devaluation is a near-perfect offset to tariffs. The devaluation tactic not only lowers Chinese export costs, it increases US export costs, as shown in Chart 2 below. Chart 2. With the trade wars and currency wars now commingled, what are my predictive analytic models telling us about the prospects for Chinese stocks in particular and China more broadly? Right now, they're telling us that China is not backing down from its aggressive response to Trump's tariffs. The Trump team shows no inclination to back down either. The result will be constricted bilateral trade and slower growth at the margin for both countries. A declining Chinese stock market, as reflected in the FXI price, will be collateral damage in this escalating struggle. It's not a result that China wants, but it's a price they will pay in order to keep Chinese citizens employed and assembly lines humming. Lower unit labor costs combined with higher US tariffs will shift wealth from Chinese enterprises to US importers, but there should be little change in the local currency earnings and job security of Chinese workers. That's the line in the sand the communists will defend. The combined trade and currency wars are like a perfect storm aimed at FXI. Wall Street is misreading these developments, but you don't have to.